Fundamental Analysis of Stock Part 2. Number 6. Price-to-book ratio, or commonly referred as PB-. PB is equal to price of the stock divided by book value per share. Book value per share is total money left after selling all the assets divided by total outstanding. Example: Company A, if suppose get bankrupt tomorrow, can get $5,000 after selling all the assets, like office, chairs, tables, etc. Total shares outstanding for company are 10 shares. So book value per share is equal to $500. Current price of stock for Company A is $400. PB will be 0.8. Thumb rule: price-to-book ratio should be less than 2. Which is good. A PB ratio equal to 1 means that you are paying the auction price for company. It is considered a solid investment. Benjamin Graham suggested to invest in the company which is having PB equal to 0.66. Number 7. Price-to-earning ratio, commonly referred as PE-. PE is equal to price of stock divided by earning per share. Example 1. Price of stock is $100, EPS is $10, PE equals 10. Example 2. Price of stock equals $20, EPS equals $1, PE is 20. Some of the important point to remember about PE are: the higher PE, the more riskier it is, since it is difficult for high PE to meet the expectation of analyst. In short, lower PE is highly desirable. Higher PE means that the price of the share is more as compared to the earning of it, which means that the investors are just articulating that the company will give profit based on emotions. Two types of PE. First, forward PE is price per share divided by expected earning by analyst. Trailing PE equals price of stock/EPS for last 12 months. Current PE should be less than the average PE of past 5 years. Take the average of PE of past 5 years. Number 8. Price-to-sales ratio, or also called as PS, or can also be called as PSR. PSR is company's total market value divided by most recent 4 quarters of sales revenue. Or more simple formula is current_stock_price divided by sales_per_share. You don't have manually calculate it. It is available in majority of stocks websites. Let's take an example. Company A. Total outstanding shares is 10. Current price of stock is $400. So total market value is $4,000. Total sale in last 4 quarter is $10,000. So PSR will be 0.4. Something to note: less PS or PSR, the more good it is. Ratio below 2 is an ideal and awesome, but not a requirement. For all companies except utilities company, smaller is better. Like all ratios, the PS ratio is most relevant when used to compare companies in the same sector. It simply tells that the sales of the company is very high, and stock price is very less. It will eventually be noticed by brokers and price will go up. The lower ratio says that the company is undervalued and the higher ratio says that company is overvalued. Number 9. Price to free cash flow ratio, or commonly called as P to FCF. This measurement tells what is left of sales after all the expenses paid. P to FCF is price of the stock divided by free cash flow per share. Free cash flow is the cash left over after operating cash flow pays for capital assets, such as land, building machine, equipment, etc. Free cash flow yield, or commonly known as FCFY, is free cash flow per share divided by price of the stock multiplied by 100. Example: price equals $400, Cash flow per share equals $1.80. So P/FCF is 5 and FCFY equals 20%. Note to listener: is P/FCF less than 5 or smaller? It is better. FCFY or price/free cash flow should be as high as possible. It is a good indicator of low valuation and positive return ahead. This measurement shows how much you are paying per share of company's cash flow, the stream of cash left after it pays expenses. Bill Miller calls it as single best predictor of excess return. Ideal is smaller is better, which means that you are paying less for the share of company's cash flow. Ideally it should be less than 5. But it is just a rough timelines because this vary from size of companies. Some analysts prefer P/CF over price to earnings, PE, since earnings can be more easily manipulated than cash flows. Number 10. Return on equity, or commonly called as ROE. ROE equals net income divided by total shareholder equity. ROE is considered a gauge of a corporation's profitability and how efficient it is in generating profits. Because shareholders' equity, which is denominator in above formula, is equal to a company's assets minus its debt, ROE is considered the return on net assets. Warren Buffett considers this as one of the best indicator when you are planning to buy any stock. Ideal is 20% or more. Look for the last 4 to 6 quarter ROE. It should continuously be consistent or increasing. Number 11. Shareholder yield. It is the combination of dividend yield plus share buyback by companies. Statement of O'Shaughnessy. Investors who wants to invest in high dividend yield stocks should stick to large better-known companies. When you include other criteria, such as strong cash flow, large sales, large number of shares outstanding, large stocks with high dividend yields, offer excellent risk-adjusted returns. These companies can easily be found in Dow Jones Industrial Average, and those are of 30 companies in Dow Jones. In an interview, William Priest indicated that shareholder yield is a term that we came up with to reflect the various ways dividends can be paid to owners of a business in a publicly traded company. He describes 5 things that a company can do with its free cash flow. 1. Paying a cash dividend. 2. Buying back stock. 3. Paying down debt. 4. Reinvesting in the company. 5. Making acquisitions. A higher shareholder yield is always desirable, as it indicates that the company is returning value to shareholders through a combination of cash dividends, share repurchases, or debt paydown. As indicated by Priest, all 3 methods are ways that a company can distribute cash to shareholders. With the growing number of share buybacks replacing cash dividends as the method of returning cash to shareholders, shareholder yield is powerful in that it incorporates both share repurchases and cash dividends in its calculation. Therefore, it is a popular alternative to the dividend yield. Number 12. Price of share in last 52 weeks. That is 52 weeks low or high. This is very common parameter when you open any of the finance website, like Yahoo, E-Trade, or any other financial website. This is very important parameter, no matter you're a growth investor or value investor. For growth investor, they prefer the current price to be near the 52-week high, so that the stock may go more high. For value investor, they prefer the current price be near 52-week low, so that it can again regain its place. Number 13. Average dollar daily volume, or also called as ADV. Average dollar daily volume is the average number of shares traded within a day in a given stock. Below are some of the features. 1. Daily trading volume is how many shares are traded per day. Average daily trading volume is typically calculated over 20 or 30 days. 2. Calculate average daily trading volume by adding up trading volume over the last X number of days. Then, divide the total by X. For example, sum the last 20 days of trading volume and divide by 20 to get the 20-day of 3. Sizable volume increases signify something is changing in the stock that is attracting more interest. This could be bearish or bullish depending on which way the price is heading. 4. Decreasing volume shows interest is waning. But even declining volume is useful, because when higher volume returns, there is often a strong price push as well. Number 14. Market cap. Market cap, or commonly called as market capitalization, refers to the total value of all a company's shares of stock. Some of the features of market cap are: 1. Market capitalization refers to how much a company is worth as determined by the stock market. It is defined as the total market value of all outstanding shares. 2. To calculate a company's market cap, multiply the number of outstanding shares by the current market value of one share. 3. Companies are typically divided according to market capitalization. Large cap is $10 billion or more. Mid cap are $2 billion to $10 billion. And small cap is between $300 million to $2 billion. The end. Thanks for watching and please subscribe my channel.